So today we are going to continue on terminologies in forex trading. Okay, continuation. So let's start from equity. What is the equity? Equity is just the money in your forex account, and this is going to take into consideration before you can open a position. Both the balance, the loss, and the profit. So let's go to execution. Execution is when you take an order, you complete an order in the market. Just like the way we have it in the normal English, like I executed something, like I execute GBP JPY, you completed an order in the market. We have the free equity. The free equity is the amount of equity not used in the trade open in the market and therefore available to be withdrawn, assuming you have a $1,000 account and then you are using the smallest macro lot, which runs on a $100 space. So that means you have $900 left to withdraw. But when you talk about some will not actually allow you, because we have some funded accounts. We call them funded accounts. And the reason why is because you are going to pay like maybe $120 and they are going to give you like maybe $3,000 account, and then after trading, your minimum balance in that account will be $3,000. You cannot withdraw it. There is no way you can withdraw it, no way. But the profit that you're making, maybe you are making $100 profit in a day, you can actually withdraw that. You understand? You can withdraw that. So that's how some of these things works. Now let's go to Fibonacci. Fibonacci retracements actually do work. Is a technical analysis tool that we use in the market, and we use to measure, because we believe that whenever a trade goes, there should be a possible reversal in that trade, and we usually use them as a level of support and resistance. Okay, now we believe that when market goes like this and goes up, there must be a retrace back before it start going up again, because market is not like something that goes up and never comes down. So even on the downtrend as well, we believe that even though it goes like this, it's still going to come back here, then start going back to where it's going to. So this is the tool. Yes, here, right here at the left hand side of you can see it, Fib retracement. Then you click on it and then you measure. Do you understand now? So this is how it works. So but with time, when we get the class there, when we are almost there, I'm going to explain how to use this to help you in forex trading. So it's really going to be helpful. It's going to be much more helpful for you to understand and to use it. Let's talk about going long. But don't forget that long itself is what is buying the market. So going long is what is that you are purchasing the currency, right? I can say, oh, I'm going long on gold. That means I'm purchasing gold. The same thing with going short. Don't forget that short in the market mean what? Sell. So when I say I'm going short, that means that what? I'm selling a currency. Okay, I hope you understand that. So more so, let's go to gap. What is gap in the market? Gap. As the name sounds, gap is a break between price that occurs when the price of an instrument moves sharply up or down with no trading occurring in between. If you've actually like opened your meta 5 or 4 before, you can see that within your price like this, which is actually almost green, there is still another one red. Yes, either you are trading or not, either the trade is going up or not, you always see this. It's always like two lines. The two lines, this gap within it is this thing within it is the gap. Is the gap. Sometimes it serves as a significant impact on the execution of pending orders. Sometimes is the gap that goes to the broker. Sometimes is the spread. Sometimes some is the spread that goes to the broker as well, like a commission on their own trading. Either your trade goes up or comes down. This gap belongs to your broker, and when you place a trade, like maybe you place a trade now, immediately your trade will firstly run at loss, like $3. I think that's the biggest. $1, 50 cents, 3 cents, depends on the loss side that you use at that particular moment in time. So let's talk about head and shoulder. What is head and shoulder? It's like a pattern in the market. We tend to have like 3 peaks, the one in the middle being higher than the surrounding two, because this is always how we have it in the market. When we have a head and shoulder, it's always like this. Okay, when we get to the practical part, I believe that we are going to understand this more better. Then we have this as the shoulder. We have this as the shoulder. We have this as the head. And we have this as the what? As the shoulder as well. But then we now call this the left shoulder, the right shoulder, sorry. Just like we have it in our body, why we call this the left shoulder. So it's work like when the right shoulder is being formed, there's going to be a sell in the market, or we have it upside down as well. It can actually come like this as well. And we're going to have a buy. So it happens like that as well, where we have left shoulder, head, and right shoulder. So when we get there as well, we're going to work more on that. And then we have something called edge. Let's just say edge and edging. Edging is the act of, edge in the market. Now, this is when a trader tries to reduce their loss in the market. The fact that it's trying their loss in the market. That's the meaning for hedging. And how is it been done? The act of buying and selling at the same time. That is how it's been done. When you are buying and you are selling at the same time, the same moment, that is what is called hedging. Because maybe now you place a position in okay, let me just make a simple example. Let's say you placed a buy here, like you placed a buy here, but the market keeps selling. And after you realize that this market is selling, you now place the sell without you knowing the time the market is going to reverse back. You place a sell. Okay, so it's kind of like not so good, but you're trying to like edge your money instead of you to like close this. Actually, if you are using stop loss, you can experience this kind of a problem. But let's just say for edging, what it means, I'll just explain it for it. Okay, there's no principle to this right now. Sell, and you place a sell here and it keeps going down, down, down. You took your sell profit here and then you buy again. You buy the market again from here, and maybe like the market now starts coming up till it touches back to your buy, which is already like a very large loss or almost close to it, because you gain your money back, then you close the buy. It's going to reduce your loss. That's what it's called edging in the market. That's how we use it. But you know, as a professional trader, there are sometimes you have to avoid some certain things before you start edging in the market. So let's go to intraday. What is intraday trading? You know, these are trading that you did just during the day. Like you open the position during the day and it all ended during the day as well. Let's go to leverage. What is leverage? Leverage is a way for an investor to build their trading power and manage a greater position in the market with a nominal investment. And the reason for this is that some broker that we have, actually, we allow you, when you see some leveraging, they allow you the 1:30, some 1 like 100 or something. It's just like a way to allow you to use your equity, the money you've like funded. Some online broker can allow you to like leverage trading up to like 30 times of your investment. Like now, maybe you fund $100 account. You can place a lot of trade on it, as much as 20 trades. Like maybe you are entering like 0.01, 0.01, 0.1, 0.02, like, because the trade is actually running to positive. Like this now, maybe the trade has been selling. I now keep selling. You keep selling, you keep selling, you keep selling, you keep selling. But over leveraging can actually affect you and damage you in the market, because the danger of it is that you're selling, you're in profits, right? You're selling, you're happy. But if this market reverses back with a quick rejection, you're going to be stopped out of the market, and that's a great loss. So it's better to just leverage in a normal way and don't ever over leverage. Well, one of the terminologies is actually line chart as well, which I believe that we've done already. I made a illustration of it for us and how essential it is to do line chart. And it's actually good for someone to know what line chart is in the market. It's just like all like lines and lines and lines and lines. Let's move forward to limit order. What is limit order? It is a pending order used to close a trade when the market is moving profitably to the open position. Okay, let's assume now that you open a trade here. Actually, open like a buy trade here. You open a buy trade here, right? And then you are wishing the market to like, go to your TP. Let's say the TP is here, and your limit order, you've already set your limit order here. The limit order that's going to be here is actually going to be TP, which is take profit. And then it touches it gets your like TP, and then you take it like take the profit itself. You don't have to like stress about it. You don't have to, like, it's going to be automatic as far as you said it, and then you've done your analysis before, knowing that the market is going to touch there. So when it gets to the price, is going to take the profit for you automatically. So let's go to long position. Don't forget, anytime you hear anything about long in the market, it mean what? It mean buy. Long position. I have some long position running. That means I have some buy position running in the market. If I say I have some short position running, that means I'm saying that I have some sell position running in the market. Like, hello, I have some long position running on gold. So that's what it means. Let's check lot size. Let's just do lots. I've actually like did this in one of my previous video about lot. You know, a standard lot is $100,000. Yes, like one standard lot. But actually, this varies with brokers. You know, like $100,000. Like, so taking 100 lots, taking one lot is it's kind of heavy because it depends on your trading account to take it and on which assets you are taking it. Don't forget we have different type of asset. If you are taking one lot on gold and you go against spike, it's actually going to be dangerous for you. But depends on your account, your trading account. Depends on what your trading account is. Depends on how your trading account is. So these are the things that are going to help you before you can just go into the market and using lot size. So imagine you use 0.1 on like let's say like $1,000 account. That's cool because you are actually going to be risking like 10% of your account. No, sorry, 1% of your account. And 1% of your account of $1,000 is just like $10. So if you are risking that, it's actually cool. Instead of risking like one lot, you know. Imagine you trading volatility 75 index and you're using one lot there. One lot on it is equivalent to one lot on it. If you take one lot, one pip is equivalent to $1,000. Imagine you run into that kind of loss. So it's actually just good to use a proper lot size in the market and grow steadily. There is nothing to be to rush about when it comes to trading. If you don't take your time about trading, it can actually be harmful to you. So let's say margin. Let's go to margin. What is margin in the market? Margin is the minimum deposit needed to maintain an open position. Okay, now, so let's say you have a $1,000 account now, and you're actually just trying to like take like 10 lot size. No, it's going to say error. It might say error on some assets. Like let's say like Nasdaq now, because it's very volatile. It might say error. So you actually need a proper amount of margin, like a proper amount of money on account before you trade. But plus, this is how I want to explain this margin for you to understand very well. You see, the margin is like sometimes you see you're out of margin and your margin is going to be red. Maybe probably after you've placed so many trade or too much of trade that is not supposed to be placed. There is not going to be availability again for you to place any trade. It's not going to allow you again. Your margin, you're out of margin. You are out of margin. And then when you are out of margin, what happens after that? You are going to have a margin call. Yes, you're going to have a margin call. Your broker is going to alert you. Once your broker alerts you, that means you are running out. Like you are running out of the market. You are about to get stopped out. Get stopped out in the sense that you are about to be, to be taken out of the market. You're going to bust your account. You're about to lose the account. Only if maybe the trade reverse, hopefully. So that's the only way out. Let's go to momentum. What is momentum in the market? What is momentum? Momentum is actually like an indicator in the market that helps to let us know where the market is going. So like let's just say the momentum actually is like, okay, let's say market is going in a direction. I will say this market is going in an uptrend. That's what I'm going to say. The momentum is uptrend. Unless on the other way around, maybe the market is just going like this. The momentum here is what? It's downtrend. So the momentum is just like the direction, but we have a tool for it. We have an indicator for it. Okay, let me bring it out. Momentum. It's actually going to like try to tell us, can you see it here? The movement of the market as well. Yes, it's going to tell us where the direction of the market is like, kind of going. This is actually on a downtrend now. It doesn't mean that this market is going to be on a downtrend, but it's like well, how do I say it? The way it is actually going in the real market. Actually, here the market is going to like a kind of ranging, not so much of downtrend or whatsoever, but the momentum recognizes to us that there's no more momentum in the market because today is Saturday. Yes, Saturday, and there's no more trading. Trading ended already, so there's no more much activities in the market. So this is where we are going to stop today, and we're going to continue in our next video. Please subscribe, like, and comment, and you can actually get to me through WhatsApp or my Telegram channel. God bless. Thank you.